Fusion Mobile, quality e-learning experience on the go.
In accounting, the golden rule of double entry states that for every debit entry, there must be a corresponding credit entry. And for every credit entry, there must be a corresponding debit entry. That is, when the books of accounts are opened, if an account is debited based on a particular transaction, then the other corresponding accounts must be credited. That explains the golden rule of double entry. It states that we should debit the receiver. Who is the receiver? The receiving account. And we should do what? We should credit the giver. For example, Ade bought 20,000 naira worth of goods from Tolu company. Who do you debit? Who do you credit? Now, based on cash basis, you credit which account and you debit which account. The two accounts in the book of Ade is purchases, and in the book of Tolu is sales. You debit purchases accounts and credit sales accounts in the books of Tolu. Source documents are basically documents that provide information for the preparation of the books. Don't be surprised. Don't be confused. They are what you're familiar with. Have you ever seen a voucher before? Have you been to a supermarket, then after buying some goods, you have been issued a receipt? Have you been to the ATM machine, after withdrawing your money, you get a slip? They are all source documents. What do? They provide documentary evidence about financial transactions. They show the validity of financial transactions over time. Source documents include the following: invoice, debit notes, credit notes, petty cash voucher, statement of accounts, and receipts. First, source documents are used to show debit and credit balances in the account at regular intervals. Having explained source documents, it is important to understand the books of original entry. The books of original entry is also known as books of prime entry. The source documents provide information that are recorded in the book of original entry. Note, they do not form part of the double entry, like we have rightly explained earlier. Accounting equation. What is accounting equation? Basically, the totality of financial accounting is based on the accounting equation. That is, without a proper understanding of accounting equation, it would be very difficult to appreciate financial transactions as they occur. Now, let's explain the variables. Assets. What do you understand by assets? These are properties of a business expected to generate future wealth and benefits. How do I mean? We mean that assets are the wealth of an organization that are expected to be used to generate future or further wealth. Examples are plants and machineries, equipment, stock, land and buildings, cash, bank. A good look at the following examples indicates that they can be used to generate future wealth. Your plants and machineries can be used in the production of goods and services. Your land and building can be used to house your organization, which will in turn generate services that will in turn generate income to the company. Cash can be used in the purchases of goods and services. Capital. Capital as another variable under accounting equation is the owner's contribution or wealth or amount invested in the business. It could also be the net worth of a business. Subsequently, you will understand what we mean by capital. Liabilities. Liabilities are the amounts owed by the business to outsiders. That is, obligation of a business enterprise or a company to outsiders. The equation is as simple as this. Assets is equal to liabilities plus capital. Note that the two sides must be equal. That is, assets must be equal to the summation of liabilities and capital. Now, let's make each of these variables the subject of the formula. Let's take assets. If we use asset as the subject of the formula, what do we have? We have assets is equal to liabilities plus capital. Let's take liabilities as the subject of the formula. Liabilities is equal to assets minus capital. Let's take capital as the subject of the formula. Capital is equal to assets minus liabilities. The ledger is a book which contains, in a classified and summarized form, a permanent record of all transactions. Note, it shows a permanent record of all transactions. The table here explains ledger and other accounts under it. Under ledger, we have the personal ledgers, general ledgers, private ledgers, purchases or creditors ledger, sales or debtors ledger, nominal ledger. Now, the personal ledgers could include purchases accounts, sales accounts. General ledgers includes real and nominal accounts, that is, accounts that relate to income and expenses, while the private ledgers relate to capital and drawings, basically. Purchases or creditors ledger relate to suppliers or creditors accounts. Sales or debtors ledgers relate to customers accounts or debtors accounts. Nominal ledger relate to losses, expenses, income, and gain. The trial balance can be defined as a list that shows the debit and credit balances extracted from the ledger to show the arithmetical accuracy of the ledger. Now, we explained the ledger earlier. Accounts in the ledger are being brought to the trial balance, and as such, the debit side of the trial balance and the credit side of the trial balance must be equal to show the accuracy of the ledger. Rules of the trial balance. Assets are always on the debit side. Liabilities are always on the credit side. Income are usually credited and expenses are usually debited. A good understanding of these rules will enable our further understanding as we move on. Uses of trial balance. 1. The trial balance helps in testing the accuracy of the double entry. The trial balance also helps in the preparation of the financial statements.
Fusion Mobile, quality e-learning experience on the go.